Everyone at RE Plus, I'm Sean Swentek, host of The Future Current. I'm joined today by Chris Clement, CFO and CIO, not information, investment, from Encore Renewable Energy. Really excited to be presenting here today on the Power Up Live stage, presented by Wärtsilä, wonderful company. They were just up here talking about energy storage solutions. Really excited to talk to you, Chris. Your Encore is one of the leading IPPs in the space today. You guys transitioned from a traditional developer and flip model to an IPP, and we're going to talk about that today. Can you kind of paint a picture of Encore's journey from that initial model to where you are today? I know you built like a huge reputation as a company that does brownfield development, complex sites. You've really embraced the asset ownership model of IPP. Can you talk a little bit about the transition?
Absolutely. First, to give a shout out to Chad Farrell, who founded Encore in 2007. So this has been a long journey, a journey of humble beginnings, let's say. I joined Encore in 2022. At that point in time, Encore had moved from being a pure play developer, and I'll circle back to that term in a moment, into being a developer EPC. The focus was initially in our home state of Vermont. Yes, Vermont is a cold and relatively dark place, but solar does work there, does thrive there, and so we're in upper New England, and have expanded from Vermont in our initial beginnings in the late 2000s. The progression from going from pure play developer to developer EPC fed into what at the time was an inkling of an idea that the IPP model was going to be a fulfillment of a mission that Encore already started with, which was to be a community partner, to be a partner for our utilities, to have a long-term ownership mentality. And so we started building the capabilities to fulfill that full stack, that vertical integration that's essential for being a developer IPP. And that's a distinction I'd like to draw, like that some IPPs are acquisition vehicles. You buy projects, you build them, you operate them. We're vertically integrated IPP in the sense that we're originating, developing, constructing, designing, and now owning and operating projects. And so the impetus behind that started with our founder Chad and our other co-CEO, Blake Sturkey. I was brought on in the beginning of 2022 to help transition us from that developer EPC model into being an IPP. And I'll paint that picture in broad strokes. The world of being a developer EPC is one of constant churn. There's a constant throughput. The model that you're working, like your business model, is one whereby you're earning developer fees, you're earning margins. There's a certain rockiness to that, like the consistency with which you can push projects through on timelines that are dependable and so forth. It's a difficult thing to manage. And so part of the idea about moving into being an IPP was getting to that point in time where we're not just riding the wave of profits and developer fees, but actually moving our projects into long-term ownership, recurring revenue, building an asset base, which is the foundation upon which you are building both enterprise value, but also being able to manage the capital, justify the capital that's necessary to really be in our industry.
You mentioned the term pure play developer. Can you just share for people who might not be familiar with that, what that is and how it differs from that developer EPC IPP model?
Yeah, pure play developer is quite straightforward. This is your site origination, your contracting, your permitting. It's putting in place everything that you need to have a buildable asset, but it's just a hypothetical asset until you build it. And so a typical pure play developer is taking a project from its initiation, its inception, through to call it a close to NTP point in time, where you have a fully buildable, de-risked project, at which point you're selling it to an IPP and generating developer fees at that point in time.
I know you only joined a few years ago. You said 2022. Company's been around since 2007. But are you familiar with, was there a market inception point? Was there a point in time where Encore said, we want to transition from developer flip model to developer EPC model? And was there a market influence that drove that decision?
We had a sneaking suspicion that we were building projects that our institutional buyers, who kept coming back for repeat business, thought were of really high quality. So the cultural shift of being a long-term owner was a really modest one for us, in the sense that we were bringing that long-term ownership mentality before we were a long-term owner. I think that there certainly was an inflection point as infrastructure funds, private equity investors, strategics started to see value in platforms and to see that you would ascribe value to the engine of development.
Yep.
And then the implementation of projects and operating on your balance sheet. Whereas before, kind of the investment model was more around operating assets, fully de-risked. There wasn't a sense of how you value a development pipeline. And so getting into 2020, 2021, 22, there was a period of, let's just say, exuberance in the market around investing in platforms. And that indicated that there was a market opportunity. There are always windows of capital availability, and this was one that we were admittedly on the tail end of. When we initiated our initial equity raise process. That was in the beginning of 2022, shortly after I joined, and that took us through the point in time where we had the IRA come. I have a distinct memory, in fact, of going into an investor meeting with the IRA having just passed 20 minutes before, and we're trying to digest, like, oh my gosh, this is giving us such a different landscape, such a different value proposition, such a different investment thesis and Encore. How do we digest this, and how do we, use this as a way to assuage some of the concerns in the discussion around, what, like, policy certainty. And so we ended up transacting with SUSI Partners, a Swiss fund out of the Swiss fund out of Switzerland, and in March of 2023, and that was really the beginning of phase one in terms of recapitalizing. We cleaned the debt off our books. The progress of being the phase of going through pure play development and developer EPC was one of progressive, larger development capital financings that supported our growth, and we kind of wiped the slate clean, brought on SUSI Partners, and I'll pause until getting to the next phase before I jump too far ahead.
Well, you mentioned the term policy certainty, which I think everyone in renewables realizes is an oxymoron because we don't exist. This is our coaster. But as a developer, you're selling a de-risk project, and then as you move to developer-EPC-IPP model, there's specific value that you're bringing, right, in that asset ownership model, and maybe it helps drive some policy certainty. Can you just talk about what were you leaving on the table in a developer flip model that is different today in your new model?
Sure. The financial analysis would suggest there are many phases of a project, and in the DG space, there's less desegregation across the value stream from a site control early stage development asset to an NTP asset to an operating asset. In the DG space, it's a little more consolidated, but at every stage, you could argue there's a margin. There's a developer margin, there's an EPC margin. As a long-term owner, you're collapsing all of that margin, and you're really paying it forward. You're using it as effectively it's part of your equity stake in these projects, and it's the means by which you justify being alongside your project finance partners in the game for the long term. I'll pause that.
Can you talk about your relationship with your financing partners, how that's evolved? Because obviously the capital stack in long-term asset ownership is much different than in the developer flip model. How has that financing partner relationship had to change for you guys to still be successful in the new market?
Yeah. So as I mentioned before, prior to our partnership with SUSI, we had worked with, and I'll just call out some names, all a huge part of the Encore story. We worked with Leyline, we worked with Greenbacker, we worked with Lacuna. These are all sophisticated, structured finance solution providers for development capital facilities. When we moved into working with SUSI, we paid all that off, cleaned up our balance sheet. One of the critical things I would offer as being a key consideration for any IPP is alignment with your capital partners. And so when we did the deal with SUSI, they have a controlling stake in the company. We are right alongside with one another. We have a shared fate, and that for us was critical. There's lots of other ways to arrive at a similar solution at the high level. Preferred equity structures, DevCo, AssetCo structures that just create hurdles, that create some differences in incentives across parties. And for us, it was critical for SUSI to be with us on the journey, and that's paid out in dividends. The phase two of our process was getting to being a fully capitalized IPP. Equity partnership is great. You cannot finance everything with equity. And so cast forward about a year, and we're into the process of having a bunch of projects in construction, and we've amassed a volume that now justifies institutional capital on the project finance side. So that's when we started working with Brookfield. November of 2024, we closed what I would suggest is a pretty innovative, multifaceted debt and tax equity structure with the Brookfield Credit Infrastructure Fund. And at that point in time, we have the full capital stack. We got debt, project finance, equity, and in my mantra in all of this, in the DG space, we're plying through volume. Like, we have dozens of projects at various stages of development and construction and operations at any given time, and we need efficiency. We need transactional efficiency. There's a tendency to over optimize and kind of drive toward like lower cost of capital, but there is a friction that it comes with that, and that friction is both quantifiable and as evidenced through our legal bills and other related costs. And the keep it simple model is what I was striving for. So we've got an equity partner with alignment. We have a one-stop shop project finance partner with Brookfield. We are doing ITC transfers, so that introduces like a third-party buyer, but there, let's just say, is a different type of capital partner, a much more limited exposure to us. And because we're approaching this all as these are all platform investments. We have, interestingly enough, like a similar but different level of alignment with equity and debt, and being invested in not just, hey, you've got some projects that you need to construct, like we'll run the numbers. This is a real simple proposition, but no, in fact, we've got investment across our development engine moving projects into construction, our acquisition engine also kind of feeding our projects into construction, and everyone's moving in concert. And that is how you enter into the tumult that we are living through right now, with a sense of having aligned partnership to help navigate through some of the hurdles. And one of the critical things in all capital partnerships is you have to evaluate, like, can we arrive at alignment in our documentation?
Yep.
Can we then understand that our documentation will be imperfect? It will not fully contemplate the future. There are things you need to work through, and having partners that can collaboratively work through issues with you and not use any moment of leverage as a moment to extract value. That's where our focus on capital partnerships gone.
I think the common thread there across Susie, Brookfield, everyone you mentioned, is this like mission aligned long-term strategy that everyone's bought into. And that's the only way you can succeed, when you're leveraging, serious dollars on these deals. And you've got a long-term owner's mindset from day one as an IPP. How does that change your project selection criteria? Are you like looking at like co-located storage all the time? Are there other factors that play into like an asset strategy as you move from developer to IPP?
Sure. I'd say that there's a little bit more of a high level focus on long-term portfolio construction.
Mm-hmm.
And so as opposed to a little bit more of like a capitalize on what can be limited windows of opportunity in certain markets. And so we've certainly had significant geographic expansion.
Mm-hmm.
So as I mentioned, our home base is Vermont, and so we're in all the New England states, but we've since moved to the Midwest. We've moved south. We're expanding with deliberation and some caution, and that's that every state is a world unto itself. I wouldn't really say it's changed anything about our site selection necessarily. I would say that it's emphasized the need to be very humble about how transferable a knowledge and experience set is in a certain location to another. There is a sense that, man, if we can, in Vermont, we had this saying where there's a semi-litigated state level process that we have to go through for every single permit. Yep. And it is a rigorous but very call it like a science-based process. And I would offer that it's one of the hardest permitting processes to go through in the country. Yep. And yet that does not translate to many other locations where there's more local level permitting. It is not as much of a fact meritocratic kind of process that we see in Vermont. So you have to enter into every new state with humility, with an on the ground presence, with a real sense of curiosity around exploring and recreating a fact set for that particular place.
I love that. Beyond the physical assets, there's obviously a whole new technology, software stack, everything that comes with moving from developer to IPP, monitoring, O&M, reporting, financial reporting, obviously to your partners. What were some of the biggest operational hurdles that maybe like came out of that transition that you would share with someone who's looking about? You're like, do you want me to list all of them? We only have 10 more minutes here.
Yeah. There's certainly a massive push for data. Your economic model is a relatively simple one as a developer. You have suppositions around how to understand how your buyer partners are underwriting to your own projects, but you're not doing that work. Um, to be effective in project finance, you need a really robust project management system that then flows into that where there's integrations and with your accounting system, and that then ultimately needs to flow into your asset management system, your DAS system, all of the data that comes from our operating projects. And that was actually one of the things I failed to mention earlier, which is that our engineering team was dying to get, like, give us the data from our operating projects, which we were not given access to when we were selling projects to institutional buyers. And now, that virtuous cycle of we're creating the learning from our operating projects through seeing like how design considerations like played out in the real world, seeing what weather variability and so forth, how that's affecting our operating asset performance. So it's a while keeping it brief, it's an enormous kind of coordination and IT design challenge to move into being an owner operator.
Yeah. Obviously, there's a lot of frothiness in our market right now. I was talking to my chief strategy officer. I think he said there's like 32 significant C&I portfolios for sale right now. There's a lot of things happening on the M&A side, a lot of consolidation. Is this like the inevitable future for the majority of like C&I, either DG or utility scale developers? Is it like IPP the model that's going to work for most in this kind of difficult market, or do you think there's still value or like opportunity just to be a developer and flipper?
I think there'll always be value for pure play developers, but there's a lot of there's risk in that model. I think it's not a I don't envy our developer partners in many respects. There are definitely some moments of where you think, wow, like, these guys have found a pot of gold.
Yep.
And then there's some really dry moments as well, and there's a lot of exposure to market variability. I mean, going into being a developer IPP is not for the faint of heart. It's not I think, a strategic necessity for survival. I do think there will be consolidation in the market. I think more of the operating asset kind of acquisition focused IPPs are trying to move upstream,
Yep.
to have more development capabilities. And similarly, I think those of us that started more on the development side are considering moving more downstream in terms of being capitalized in position to being an acquirer of operating assets, because that that is now a big part of the transaction flow in the market. So it's something I think that we see often. Our partners ask us, like, how could we follow your model? Should we follow your model? Is it essential to follow your model? And I'd say the understanding that this is not, like, there have been instances where I think there's been an underestimation of what it means to build a project finance team, to build an asset management team, to then manage all of the exposures and the risks that come with that long-term ownership model. And so I think if you cast ourselves forward, there'll be more consolidation, but there's still going to be a very diverse ecosystem of actors out there.
Yeah. Speaking of looking forward, if 5 to 10 years from now, what does success look like for Encore? Is it measured in megawatts and gigawatts? Is it geographic expansion? Is it new technologies? What is like your success metrics for the future?
A little bit of a leading question. I'm going to give you a different answer. I think part of our success is going to be born out of, has Encore emerged as being a force for generating on the ground political capital and support in our communities with our utility partners. We need to be a part of a broader movement that's creating a pull factor that's considering our involvement in communities as being essential.
Yep.
And so our success is being one such representation of a group that a utility or a community looks at and says, these guys provide critical, whatever it's grid resilience, climate resilience, low-cost energy, and the solutions that we deem as both desirable and necessary. And so we really do bring this sort of partnership mentality in the sense of we see this as a collective thing that we cannot do alone, even as a set of growing, well-capitalized developer IPPs. Of course, I'd be burying some of the lead in that, like, yes, like megawatts are important. Yep. Geographic expansion is important. I do think this is a low-hanging fruit, but firm power solutions. On the DG side, there's not nearly as much solar plus storage, like hybrid AC or DC coupled projects out there, or markets that support projects like that. Yeah. And increasingly, I think we're moving in a world where that is going to be a big focus for us, figuring out those sorts of contract structures and those sorts of really kind of market and project opportunities.
In this like upcoming post-IRA world, I would assume solar plus storage plus whatever is going to increasingly play an important role in success in the market. I mean, we've seen, obviously you mentioned utility scale residential, solar plus storage is really having a moment. Is that kind of a strategy to attack, post-incentive world is looking at firming those assets?
Certainly, I'd say that's a strategy. I mean, we're all have our speculative hats on and how the future looks. I mean, one thing that certainly tickles my brain is considering a situation where one critical and like strategic decision that we made earlier this year is we have a large safe harbor strategy that we implemented in Q1 of this year. Lots of groups have done this. Those safe harbors will phase out. Like it's only going to take you so far. And as you head into 28, 29, 30, assuming that we're in the same scenario that we're in now, what starts to happen is we have projects that still can qualify for the ITC and others that don't, competing in RFPs or in the same market and so forth. That's an eventuality that I think no one is quite prepared to understand how quite to navigate that sort of competitive dynamic. But for us right now, we're certainly exiting the OB3 and the Treasury guidance process with a sense of somewhat of relief, and that we at least have reasonably well-defined guardrails that we're kind of managing within. And the post-incentive world has some benefits. There's certainly reduced complexity. You're not having to tax equity finance your deals. You're not having to transfer out ITCs to third-party buyers like that. There is simplicity to that model, which I think certainly our lenders would appreciate. But there has to be an adjustment in the power price markets. There has to be an adjustment even on how we capitalize ourselves as a sponsor. The equity requirements in that world will necessarily be higher. Yeah. Tax equity is a huge part of our our capital stack. Yeah.
If there's a developer in the audience and they're thinking about transitioning from developer flip to IPP, developer EPC model, is there like a singular piece of advice? This is the big thing you got to watch out for as you make that transition.
I'd say build trust, be radically transparent. Mm-hmm. I think vulnerability in this space can bear out with or can play out with partners that believe that they're dealing with a trustworthy counterparty that does not have everything figured out, but has the disposition to work through the inevitable challenges and obstacles that come our way.
I love that answer. We have like 1 minute left, so I'm going to add one more thing in. It's kind of a taboo topic, but developers, financiers, folks who are investing on the front end of projects, historically, there's been like overestimation of production and like not accountability to long-term O&M costs. As an asset owner and long-term holder of these assets, how has your perception changed of like accounting for like the long-term cost of ownership of these assets, O&M and all that? It's just like people don't think about that, right? And now as an IPP, you have to think about that.
Yeah, I would almost just say yes. Like it is a critical sensitivity. It's one of the intuitive aspects of being a long-term owner, which flips the model a bit. Yeah. Our team was very CapEx focused. Yep. Build costs. We've got to optimize and manage that cost. Our returns are very sensitive to OPEX. and having like the overall financial acumen of the team building towards a recognition that these items, even though they look really small compared to our CapEx numbers, are critical.
Yep.
One of my teammates in the audience here is shaking his head because this is his
He feels the pain.
yeah. So I think it's one of the key risk factors that I think it's hardest to wrap your head around until you're sitting in the seat.
Yep.
And you're negotiating every insurance contract and every asset management provider, and you're seeing the numbers, and it's not just a modeling exercise, which it starts out as being.
I think it all goes back to what you said at the very beginning. It's all about data, driving business insights, because if you can reduce your OPEX cost by even 1% across a large portfolio in the long run, that's going to probably be the difference between succeeding or not in the market. So I love that you're focused on the data. And for all the listeners, thank you for joining us. I'm Sean Swentek, Omnidian, host of the Future Current. Chris Clement, Encore Renewable Energy. Thank you so much for joining me today, Chris. It was a pleasure.
Thank you, Sean.